China is the world's largest holder of foreign reserves. Here's a graph with data that we gathered from the World Bank on the top countries with the most total reserves. As you can see, China has over $3.4 trillion in total reserves, followed by Japan with $1.29 trillion, and then Switzerland at $863 billion. Having over $3.4 trillion in total reserves is substantial. If China were to use this money to help fund developing countries, it would give them an enormous boost. It is even possible that this huge amount of money can lift the poorest nations out there to become one of the world's most developed nations. That's just how big this $3.4 trillion is. But the question that we want to know today is, just why is China's total reserves so big? What is it for? What does it mean for China's economy? Well, let's first understand what foreign reserves are, as it is the most important part in understanding China's foreign reserve rise. Foreign reserves are basically a country's savings stored in foreign currencies, gold, and other assets. These reserves are held by a nation's central bank and are primarily used for international trade, stabilizing the currency and managing the economy during financial crises. They act as a financial cushion, ensuring a country can pay for imports, service debt, or defend its currency in times of uncertainty. In the case of China, the foreign reserves are managed primarily by the State Administration of Foreign Exchange, which operates under the oversight of the People's Bank of China. Then there's also the China Investment Corporation, which we'll discuss later. So, let's talk about how China gathered so much foreign reserves to begin with. This all started because China is the manufacturing powerhouse of the entire world. The reason why this is so important is because of what is known as exports. Exports happen when China sells something from its local borders to other nations like the United States. When this happens, the US then buys whatever goods China sells to them in US dollars. This US dollars then goes to China's stash of foreign reserves. Over time, as we look at the historical data from China as published by the World Bank, we get to see that they have increased their foreign reserves every year, and in part because of this huge exports to other countries around the world. But that is the simplistic view. Here's a graph with data that we gathered from the World Bank on the current account balance, BOP, current US dollars. This data highlights the surplus China has maintained for years. A current account surplus means that China consistently exports more goods, services, and capital than it imports. And as you can see, China has had a surplus not just of billions of dollars, but hundreds of billions of dollars every single year, starting from 2005 to the latest data available for 2023, except with an outlier year in 2018. But the current account balance takes into consideration factors other than exports of goods and services, as it includes income from investments abroad, payments for services, and transfer payments such as remittances. Here's another graph on just the net trade in goods and services, BOP, current US dollars. As you can see, China's net trade in goods is so much higher, with the year 2022 recording a massive $577 billion. These datasets that show surpluses then go back to China's total reserves, as more US dollar goes into their pockets than out. Now, with over $3.4 trillion in total reserves, you might ask, what are they doing with this? Well, one of the things that often gets repeated is that China is one of the largest holders of United States Treasury securities. These are essentially loans that the US government borrows from other countries and investors by issuing Treasury bonds. Here's a graph of the major foreign holders of US Treasury securities for the month of April 2024. As you can see, the largest holder is Japan with over $1.1 trillion, followed by China with $770 billion, and then the United Kingdom at $710 billion. So, Why does China invest a portion of their total reserves into the US Treasury? Well, the answer is simple. US Treasury securities are considered one of the safest investments globally. They are also highly liquid, meaning they can be easily sold or converted into cash if China needs funds quickly. Then thirdly, this also fosters economic interdependence. As a major creditor of the US, China indirectly influences the American economy. But it is important to know that China has been reducing their US Treasury security in recent years. Here's a table published by the Congress.gov of the United States showing that in 2019, China held more than $1 trillion in US Treasury, but 3 years later, they had fallen to $816 billion, and further reductions were made as of recent months. Now, let's talk about the economic impacts to China itself. The most important one that we see is through their sovereign wealth fund. As we mentioned earlier, there is an entity called the China Investment Corporation. It is a sovereign wealth fund that manages a portion of China's foreign reserves and invests them in higher return assets. Here's a graph of the China Investment Corporation portfolio distribution. As you can see, they have many investments ranging from public equity, fixed income, alternative assets, and cash products. But what makes China Investment Corporation more interesting is when we look at their investment activities distribution by geography in their public equity. Here, as you can see in the graph, a lot of their investments as of 2023 is in the United States, with over 60.29%, followed by other countries. That means China's state-owned entities invest heavily into the United States. But just how much money do they even have? Well, here's a graph with data that we collected from globalswf.com, which shows that the China Investment Corporation is the 4th largest on their list with over 1.3 trillion. That puts them only second to Norway's Norges Bank Investment Management in terms of the sovereign wealth fund status. The second economic impact to China is that they have little risk when it comes to paying down their external debt. Yes, just like any other country out there, China also has external debt. Here's a graph of China's external debt stocks, total DoD, current US dollars, with data that we gathered from the World Bank. As you can see, while their foreign reserves are a lot, their external debt is massive as well, with over $2.39 trillion as of the latest year 2022. But due to the fact that they have enough foreign reserves, they can easily pay down any short or long-term debt. Thirdly, the massive reserves help China manage its domestic economy during turbulent times. For instance, in times of financial crises or global economic slowdowns, China can dip into its reserves to stabilize its currency, inject liquidity into the financial system, or fund essential imports such as energy and raw materials. This financial cushion ensures economic stability and provides a buffer against external shocks. Now, before we end the video, it's also important to know that there may be challenges ahead in China's foreign reserves. One of them, and arguably one of the largest ones, is no other than the coming second tenure of President Donald Trump. Why is Trump going to be a problem for China's foreign reserves? Well, if we take a look at the net trade in goods and services that we saw earlier, we see that in 2018 and 2019, China's net trade has fallen. One of the causes for this is Donald Trump's trade war with China. When Trump won in his first tenure, he imposed tariffs on Chinese goods, and China retaliated with its own tariffs. This trade war reduced the volume of Chinese exports to the United States, one of its largest trading partners, impacting its overall net trade balance. Here's a graph on the balance of trade from the US trade in goods with China, with data that we collected from the United States Census Bureau. As you can see, the balance has been growing big and fast from 2000 to 2018, and it reached over $418 billion in trade deficit for the US. But as Trump initiated this trade war, the trade deficit fell to $342 billion in the coming year. The reduction in imports continued until 2023, and even with the latest year of 2024, with the latest month of September, the deficit is now just $217 billion. One of Trump's promises in his second tenure is to increase tariffs once again to China. This might again impact China's net trade in goods, and may indeed reduce their earnings from their exports to the United States. But the connection is, however, multifaceted, as there are also other factors here that can reduce China's foreign reserves, not limited to reduced export earnings. Some factors like foreign investments, domestic economic policies, and exchange rate fluctuations also play a significant role. Foreign investments are also going to play a huge role in China's foreign reserves. As we see an increase in the diversification of the supply chain, which was partly as a result of Trump's tariffs, but as well as China's rising labor costs and other geopolitical factors also contributed to companies moving production to countries like Vietnam, India, and Mexico. But anyway, do let us know what you think. Thanks for watching.